Tonight, we need to talk about a mechanism that changes the rules of the game so fundamentally, so violently, that if you do not understand it within the next few minutes, you're going to be left behind in the ruins of the old market structure. What I am about to walk you through is a scenario that very few people in the precious metal space are talking about, not because it is happening right this second, but because the legal framework is already in place, the historical precedent is established, and the math creates a vulnerability that most investors have completely ignored. Welcome back to Veiled Wealth. Stay with me, because this is not just financial theory, this is national security law. What we are analyzing today is the theoretical application of the Defense Production Act to the silver market. And while we are not claiming that any specific order has been signed today, understanding this mechanism is the difference between being prepared and being a casualty of market intervention. This analysis is educational, it is about existing U.S. law, and it is a scenario analysis that reveals just how fragile the supply chain really is. Make no mistake, this is not financial advice, we are not financial advisors, and you must verify everything independently. But the legal reality we are about to expose is something every single market participant needs to understand. Let's get into the machinery of government power. To understand this scenario, you first need to understand the weapon we are discussing. The Defense Production Act is not some obscure relic gathering dust in a basement. It is a live, active federal statute that grants the president extraordinary powers over the industrial base. Originally passed in 1950 during the Korean War, this law has been reauthorized repeatedly, most recently in the 2020s. It allows the executive branch to effectively commandeer private industry. It allows the government to look at a private company and say, your output no longer belongs to the open market, it belongs to national defense. And here is the hook that should make every viewer pay attention right now. This is not theoretical. We have seen this power unleashed repeatedly in just the last few years. In March 2020, the Trump administration didn't ask General Motors to make ventilators. They invoked the DPA to compel them. They directed 3M to prioritize mask production for domestic use over foreign contracts. These were not requests. These were legal orders with the weight of the federal government behind them. But it goes deeper. In 2021 and 2022, the Biden administration invoked these same authorities for semiconductor manufacturing and critical minerals processing. Why? To reduce dependence on foreign supply chains. They used this law to accelerate solar panel production, heat pumps, and battery components. The precedent is undeniable. The government has demonstrated repeatedly and publicly that when they perceive a strategic gap, they will use the DPA to close it. So when we talk about silver, we aren't discussing science fiction. We are discussing a tool that is sitting on the president's desk right now. Now, has this specific trigger been pulled for silver as of today? Based on publicly available government sources, the answer is no. But the question we need to ask, the question that keeps strategic planners awake at night, is what would the mechanism look like if it were? And what happens to the supply chain when the most powerful buyer in the world cuts to the front of the line? Before we go deeper, if you want to understand the warning signs that flash before these interventions happen, I've put together the Silver Insider Toolkit. It breaks down the structural signals in the physical market that precede major repricing events, the same framework we use here at Veiled Wealth to track these developments. You can find that link below. So, why would silver be in the crosshairs? This is where the narrative shifts from finance to physics. Silver is not just money. It is the most electrically conductive element on the periodic table. It is the most thermally conductive. These are not optional features. They are requirements for high-performance defense systems. We are talking about missile guidance systems that rely on silver for reliability. We are talking about military satellites, radar arrays, and electronic warfare systems. According to materials, science documentation, silver is embedded in the nervous system of the American war machine, and it goes beyond the military. Solar panels, electric vehicle infrastructure, 5G networks, medical technology, they all compete for the same physical resource. From a strategic planning perspective, if you're sitting in the Pentagon looking at supply chain vulnerabilities, silver is flashing red. And here is why the flashing red light is so dangerous. The supply math tells a devastating story. Global refined silver production sits somewhere around 800 million to 1 billion ounces annually. But a massive portion of that refining capacity is offshore in Mexico, in China. The United States, despite its immense demand, has a domestic refining footprint that is dangerously small. Perhaps 10 to 20 million ounces per year, depending on operational status. Meanwhile, U.S. demand industrial and investment is massive, estimated between 150 to 200 million ounces annually. Do the math. We consume 10 times what we refine domestically. We are structurally, critically dependent on imports. In a world of free trade, that works fine. But in a world of rising geopolitical tension, trade wars, and export restrictions, that dependency is a national security nightmare. Now, let's walk through the scenario. Let's apply the Defense Production Act to this imbalance and see what breaks. Imagine a future where the executive branch determines that silver is critical for national defense and that import reliance is a threat. Under existing authority, they issue an order requiring domestic refiners to allocate, hypothetically, 40% of their output to government contracts. What does that look like in the real world? If U.S. refining capacity is 15 million ounces and the government takes 40%, that is 6 million ounces gone. That leaves 9 million ounces for the entire private sector. But remember, private demand is 150 million ounces. You have a gap of 141 million ounces. You have 94% of demand chasing a ghost. And this is what should make everyone lean in closer. If this policy is triggered because imports are unreliable, then the private sector cannot just call up Mexico or China to fill the gap. Those imports might be restricted, taxed, or simply unavailable. You create a bottleneck where domestic buyers are fighting over scraps. Basic economics dictates that when 150 million ounces of demand fights for 9 million ounces of supply, the price does not just rise, it disconnects from reality. Let's break down the timeline, because this wouldn't happen all at once. Phase 1 is the announcement. If the government drops a DPA order for silver, the immediate reaction is shock. Traders scramble to reassess positions. Futures prices spike as the paper market tries to price in a physical shortage. Premiums on physical metal blow out as buyers realize the allocation rules are about to change. Phase 2 is the preparation. There is always lead time. During this window, you would see intense, behind-the-scenes negotiation. Refiners would be locking down supply. Existing commercial contracts would be scrutinized. New buyers would be desperate to secure agreements before the door closes. It creates a rush, a panic buying spree that tightens the market before the law even takes effect. Phase 3 is the live allocation. This is where the rubber meets the road. Refiners are legally bound to serve the government first. Private buyers are pushed to the back of the line. If you are a company that needs silver to manufacture electronics and you don't have a priority rating, you are looking at delays, shortages, or the realization that you simply cannot get the metal. Phase 4 is the adjustment. The market tries to find equilibrium, but it is a painful, messy process. Prices settle at a new, much higher level. Some industries stop using silver because they can't afford it. Some move production overseas, where the metal is available. The market survives, but the landscape is unrecognizable. The impact on market participants would be profound. Industrial users face an existential choice: pay the premium, find a substitute, or move. Each option carries massive risk. Investment buyers face a physical market that is divorced from the spot price. Premiums explode, inventory vanishes, dealers institute minimum orders to manage scarcity, and the paper market of the futures traders and ETFs face a potential crisis if they cannot source the physical metal to back their contracts. We could see forced cash settlements, a mechanism that has been used in other broken commodity markets. Geopolitically, the implications are even darker. If the US invokes the DPA for silver, it signals the end of the global free market for strategic resources. It tells China, it tells India, that the gloves are off. We could see a cascade of retaliatory export bans and domestic allocation regimes worldwide. This is the shift from just-in-time globalism to fortress economics, where security trumps efficiency every single time. Now, how do you verify this? In the age of rumors and social media panic, how do you know if this is actually happening? You need to know where to look. Source 1 is the Federal Register. This is the official journal of the U.S. government. DPA orders are legal instruments. They are published here. Source 2 is official agency press releases from the DoD or Commerce Department. Do not rely on anonymous tweets. Source 3 is congressional testimony. When these powers are used, hearings follow. Check the transcripts. Source 4 involves industry trade groups like the Silver Institute. They will be the first to scream if their operations are commandeered. Be skeptical of anonymous sources. Be skeptical of unverified leaks. There's a massive difference between saying, this is a scenario based on law, and saying, this happened today. We are analyzing the former, so you're not blindsided by the latter. Here's the bottom line. The Defense Production Act is real. The strategic importance of silver is real. The dependency of the U.S. on foreign silver is a mathematical fact. If priority allocation were ever implemented, the dynamics we just walked through would unleash chaos on private buyers. Prices would adjust violently. Supply chains would fracture. So what happens next depends entirely on how well you prepare. If you are an industrial user, check your contracts. If you are an investor, understand the difference between paper promises and physical possession. Diversify your information sources. Verify everything. We have explored what could happen, not necessarily what will happen, but the purpose of intelligence is to build models for the unexpected. This is not a call to panic. It is a call to think critically. If you found this analysis valuable, subscribe to Veiled Wealth. We focus on the structural mechanics that others miss. Hit the notification bell so you don't miss the next deep dive. Leave a comment on what scenario we should analyze next. Until next time, stay informed, stay critical. And remember, in a market driven by strategic necessity, the rules can change overnight. This is Veiled Wealth. Thanks for watching.